Hi, my name is Vetri. I am the head of equity at UTI Mutual Fund, and today I'm going to be talking to you about my investment philosophy, which I would essentially define as an approach of value investing. Value in my book is buying things for less than their intrinsic value. Intrinsic value itself is simply the current value of the cash flows that the company generates for its shareholders over time. Of course, there could be situations where value could be unlocked by way of asset sales, but those by definition are special situations and don't come by every day. In my experience, undervalued businesses can be found at two ends of the spectrum. At one end of the market, it may underappreciate the sustainability of competitive advantages or also the length of the actual growth runway that the company possesses. These companies very often defy the norm of cyclicality and reversion to mean. At the other end of the spectrum, there are companies that might be experiencing challenges due to cyclical factors, changes in the environment, or their own past actions of the management. But if the core business is healthy and a path to a better future in terms of cash flows, in terms of return ratios is visible, then their depressed valuations today offer a very attractive entry point. The opportunity, if you think about it in both cases, is to buy something cheap relative to expectations. This approach resembles, in a sense, what I call a barbell approach to investing. I like to combine both approaches, both top-down and bottom-up. If you think about it, investing is about buying a good business at a price where it offers value and then sitting still thereafter as the business delivers. But the reality is that the market goes through waves in which sectors can experience derating and re-rating. And this provides an opportunity as a fund manager to generate alpha. An important distinction to keep in mind is that the forces of mean reversion work on sectors and sector valuations much more strongly than they do on individual companies. In other words, an individual company can experience a very differential outcome due to its competitive advantages, but for the companies of a sector in aggregate, the forces of mean reversion are rather powerful. This implies that the approach towards owning individual companies and the sector weight of the portfolio has to be different. Valuations, in my opinion, provide a prism through which one judges the attractiveness of individual sectors. My preference is to manage the portfolio with all positions carrying what we call an active positive weight. That is to say that if the fund owns a company which is in the benchmark index, the position would typically in the fund be in excess of the benchmark weight, or what we colloquially refer to as being overweight. Otherwise, the position would be zero. In other words, the strategy would either be overweight an index stock or have a zero position. It's pretty much an all or nothing approach. As for stocks that are in the fund but not in the benchmark, by definition it is an overweight position. As a result of this approach, the active risk in the strategy is quite high and the performance deviation relative to the benchmark can also be high. But if your target is to manage a strategy with a target for higher alpha, then I do believe that this is appropriate. Growth in earnings is undoubtedly the source of wealth creation over longer periods of time, but forecasting those earnings precisely is very difficult and may even be impossible. That is the message from history. It is more important to monitor how a company is managing its competitive position, its capital allocation, rather than obsessing over consensus earnings expectations and changes in those expectations. Having a positive view on earnings is different from relying on precision in earnings forecasts.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.